across our community. This is something that struck very close to home for many members of our staff, for many of our community partners, and I think, for me as an individual, for others and as an individual. And I think I want to thank those of you in the business community who have been outspoken. I know many of you have put out statements of support and solidarity with the calls for increased racial justice and for change. And that means a lot. I think that's something that I've had a number of conversations recently where people have noticed that there are more people who are speaking up and who are choosing not to be silent in this moment. I encourage that. We ask any of you, if you have thoughts or you're looking for ideas of ways to engage on these topics, please reach out to us. We are building some programming for our members to help you all navigate some of these very challenging conversations, and to think about ways that you as businesses and employees, employers, can play a more active role in supporting some of the change that we all know is necessary for our community and for our country. With that, obviously today's topic is very popular. We have one of our largest turnouts. I think we're expecting more than 300 people on today's webinar. And I was joking just a minute ago that that's either the result of the star power of our friends at Dannible McKee or the prospect of free money from the Paycheck Protection Program. So we are really thrilled to have such good partners at Dannible McKee. Mike Reilly, the managing partner at Dannible, is here to join us today to walk through some slides and help all of you understand how to go about pursuing the forgiveness portions of the PPP, something we know is on everyone's mind. I will just remind people very quickly, if you have questions, please put them into the chat. We will be tracking the chat feature throughout, keeping track of those questions. I think we'd like to let Mike get through his presentation, and then we'll come back. Hopefully at the end, we'll have about 20 minutes, 25 minutes for Q&A. And our Director of Member Services, Brian Benura, is going to moderate that Q&A with Mike and see if we can't get you answers to your many questions. So thank you all again for joining us. Mike, I'm going to turn this over to you.
Great, thanks, Rob. And Rob, thank you for your leadership as Center State CEO. You've been a great partner and great for the community. The organization's come very far since the old days with MDA and the Chamber. The combined organization is doing a fantastic job, and we appreciate it. So I'm going to be talking about the PPP loans. So many of you out there probably got your loans, and some may not have gotten your loans, essentially, but you still have until June 30th. So I'm going to talk about still a little bit how to get the loans and mainly focus on the forgiveness provisions. And then I'm going to just, at the end, talk about some tax incentives, but pretty much going to leave that to the payroll tax incentives, because it's pretty much, this is a jam-packed seminar. I really want to cover all the PPP stuff. So the Paycheck Protection Program, we'll call it the PPP program. So just in summary, eligible small businesses and organizations can apply. You can see that basically, if generally speaking, most businesses are not-for-profit organizations. You can see on the slide who qualifies with less than 500 employees can apply for the loan. But there are also some exceptions too. If you meet a certain SBA size standard, you could get it. And also, if you meet what's called the alternative size standard that was developed by the SBA, and that's a business that could have over more than 500 employees, but not more than $15 million in net tangible net worth, or more than $5 million in net after-tax income for the prior 2 years. So there's other ways to meet it if you're over 500 employees. Employee includes anybody that's full-time, part-time. If you have basically a franchise type business or a hotel food service business, the 500 employee requirement is per physical location. And then there's the normal affiliation rules apply. So essentially this program is effective. It was effective February 15, 2020, even though the law didn't pass until March 27th, and ends on June 30th. So even though there's been extended dates that we'll talk about, you cannot get a loan after June 30th. This year. So if you haven't gotten one yet, now might be the time. So where are we in the PPP program statistics? As of June 6th, the total PPP loans were 4.5 million loans. So a very large amount of small businesses have applied. The total loan amount is $511 billion. The average loan size is about $113,000. So if you're wondering where you fit in, that's the average size. And you can see on the chart here, the breakdown is 64% or about 65% is below $50,000. Only 0.6% is above the $2 million level. And that's the level that the SBA is going to review. They're going to review all loans over $2 million just to make sure the compliance is there and so forth. But there still is $131 billion of funding still available. And we think with this PPP Flexibility Act, businesses are starting to open up and start to utilize these funds. They've been on the sidelines where at first when this program started at the beginning of April, everybody got in, some got shut out. They had a second round that people got in and everybody got their loans. Now people are sitting on the side saying, okay, do I need the loan? Do I have to pay it back? What are the requirements? I got to see what's going on. The guidance has been very sketchy. It comes out a little bit at a time. And we've been dealing with these rules since the beginning of April, trying to figure out what's in the head of the SBA and what Congress's intent has been. And I think we got a lot of it figured out, but there's still some more guidance that we still need. Just some of the general definitions of the PPP program. A covered loan means a loan under the PPP program. There's a couple different covered periods. One, February 15th, 2020 to December 31st, 2020. But the important covered period that we're looking at is the forgiveness period, which is the 8-week period or 24-week period, okay, after you get your loan. That's the period that you can spend your money. We can talk about that. Eligible recipient definition there, eligible self-employed, the normal rule for that. Not-for-profit organization, small business concern. One of the things under the FTE program is that everybody, when we're trying to go through our calculations, you'll see we have to do several calculations based upon full-time equivalents or FTEs. And basically, there was not a good definition, but they came out with a recent guidance on a definition. So it's fairly simple. So when you're looking at FTEs to see if you meet the requirements, an FTE basically is anybody that works 40 hours or more. So essentially, if you're working 40 hours or more, you're considered one FTE. Okay, so 40 hours or more, one FTE. And if you're less than 40 hours, you basically divide it into 40 hours. So if you're 30 hours average, you divide by 40, that's 0.75 FTE. You can use what's called the simplified method. If you're working less than 40 hours on average, you can simply use a 0.5 FTE and use that. Wherever you use the FTE calculation, you need to use it for all your calculations, whether you're talking about a base period, the covered period, which we'll get into. But that's been simplified, so it's 40 hours, and if you use the simplified, you're part-time, you're considered a half of employee, or FTE. Some of the waiver requirements and fees, basically, the loans can be used for refinancing some certain SBA loans. There's a non-recourse provision, essentially, so the SBA has no recourse against any individual shareholder, which is good, unless it's used for an unauthorized purpose. Waiver of personal guarantee. And normally under the SBA rules, generally when you get an SBA loan, you normally can't get one if you can get credit elsewhere. So SBA loan rules were really developed for those that couldn't get loans elsewhere. That requirement's been waived. And we're going to get into the need for this PPP loan, but that requirement in terms of having other loans available has been waived for this PPP loan. And then there's the fee waivers. There's also a fee waiver. Now, here's the thing that many are concerned about, the borrower certification requirement. Okay, so when you go out and get the loan, where everybody did, one thing, you had to make a good faith certification that the uncertainty of current economic conditions makes necessary for the loan. And the borrower is taking into account the current business activity and their ability to access other sources of liquidity to support their ongoing operations. And this is key, in a manner that is not significantly detrimental to the business. And you have to use those funds for certain purposes, specified non-payroll costs and certain payroll costs. Not more than 40% can be used for non-payroll costs, which we'll get into that. And basically, you can't get duplicative loans or use loans for duplicative purposes, during the February 15th to December 31st, 2020 period. Now, the concern that many businesses have, you heard about Ruth's Chris Steakhouse, Shake Shack, the Lakers. A lot of them gave their money back because they felt they couldn't determine the need. We've had a lot of clients or people in the community ask us, do I give my money back? I'm not out of business, I'm still operating. Is there a need? And we found that for most of those businesses, there was a need. The big concern that came up, well, geez, I can use my line of credit, so I do have access to other sources of liquidity. However, if you look at that last section, it says in a manner that is not significantly detrimental to the business. So you really don't want to, as a CPA, I can't really tell my clients to go out and borrow money to keep your employees employed and not have them do anything, because you still got to pay the loan back. So in my view, that's not liquidity, because you got cash and you've got a loan on the books, so it doesn't make sense to do that. So in my case, I said, for a lot of my clients, I said, hey, if you don't need the people, if you can't use them for other purposes, you probably shouldn't bring them back, essentially. A lot of businesses said, well, bring them back to do maintenance work and other jobs, that sort of thing, that's fine. So, and what many businesses didn't know when they applied for the loan, saying, hey, we're scared of this thing, this COVID-19, what do we do? And at that time, the uncertainty was certainly there. So really what the law says, did you have an uncertainty at that time when you got the loan? And if you did, then essentially you don't have to pay it back and you're entitled to the loan. Doesn't talk about whether you're out of business or you have other sources of revenue. Talks about the uncertainty and your concern. And I found after a month of this thing, in the first month of this thing, and even now, there's still a lot of uncertainty, We don't know how this is going to affect us through the end of this year, into next year, and so forth. You might be doing okay now, but you might lose a lot of your customers and suppliers, essentially. So we think it's critical. I think you're on solid ground. And basically in conversations with other accountants in the AICPA, which is the American Institute of Certified Public Accountants, their feeling is, even if the SBA came in and says, hey, you probably didn't need the loan, the worst what might happen is they'll tell you to pay it back. You're not going to get hit with criminal charges and that sort of stuff unless you completed a fraudulent application. So I don't think there's much risk. So my recommendation, really look at that before you decide to pay it back. Also, I want to mention too, in paying it back too, under the law, when it was first established, they basically said, they had certain limitations. A lot of people applied and didn't get, the appropriate amount of dollars and so forth. For instance, if you were a partner or self-employed, many banks that didn't understand the rules correctly said, you can't get the money for a self-employed or partner, we're not going to give it to you. Or if you were working with a leasing organization, essentially, and you had leased employees, many of the banks said, hey, those are leased employees, they're not your employees, you can't get it for leased employees, essentially. Well, they modified that and said, you can get it for leased employees. There's a FAQ that allows you to do that. If you get a PEO out there, or you got employees for a leasing organization, you can go out and get financing or get this loans for those employees, and you certainly can get them for your self-employed partners. So what the SBA said is you can go back into the pot, you can go back into the well and reapply to get those additional funds. So if you went out and got a $200,000 loan, but you were shorted because of some of these other requirements, essentially, you can actually go out and say, okay, I want to include my leased employees and my self-employed partners and get another $100,000 or whatever that number works out to be. So you can still go back into the well, but you got until June 30th. Also, other sources, the ICPA indicated it's their understanding that if in fact you paid your money back, if you got nervous about it and you paid the money back, and then you realize, I shouldn't have paid that money back, I really did need this money, you can go out and apply for the loan again. I haven't seen a confirmation directly from the SBA, but I got that from the ICPA. But it's worth a shot to talk to your lender and see if you can go out, if you pay the money back, if you can go out and get the money again. If your lender doesn't want to do it, maybe another lender will. So those are opportunities that you got until the end of this month if you're still interested in the loan. You can also use it to refinance an SBA EIDL loan, essentially. There's requirements there. It's in the application. Basically, can refinance everything other than the $10,000 grant that many of you are aware of. That part of these SBA EIDL loans up to $2 million that you may have applied for, the first $10,000 was a grant. It's basically up to $10,000, or they give you about $1,000 per employee. So what are the allowable uses for this? Allowable uses are for payroll costs, which will define costs related to group health care benefits, so health insurance, basically employee salaries, commissions, rent on any mortgage obligation. You can't prepay mortgages, so interest on mortgage obligations, rent, utilities. Then you can also use it on interest on any other debt obligation that was incurred before February 15, 2020. But be careful about this, because that interest does not qualify for forgiveness piece. So you can use the money on that, but that piece would not be forgivable. Why they put that in there, I don't know. Note the maximum amount of the loan is determined based upon payroll costs, and the use of proceeds can be used for other specified non-payroll costs, now up to 40% as a result of the Flexibility Act. So basically what do payroll costs include? So for employers, it's really salaries, wages, cash tips, vacation, dismissal pay, separation, payment for group health and benefits, retirement. So basically your gross salary, which includes bonuses, vacations, all that sort of stuff, then your health insurance and also retirement benefits. And then also the payment of state or local tax assessed on compensation of employees. That does not mean state withholdings, okay? What that really means is your state unemployment insurance. That's really what it's referring to. And possibly New York State disability insurance, since that's considered a tax. Those are peanut numbers, but that's what it basically is for. So your gross wages already include, you know, your FICA tax, Medicare tax, your withholding taxes, all that, because that's built into your gross wages, essentially. So think of it as your gross wages, health insurance, retirement benefits, and unemployment, state unemployment tax. For sole proprietors, basically, it's also compensation for those individuals as well, and it's basically their Schedule C income, which we'll get to in a minute, and it can't exceed 100 grand a year. So basically, what payroll costs do not include is compensation of an individual that has a salary in excess of $100,000 a year. So you look at it on a prorated basis, essentially. So you can't include more than $100,000 of your compensation, or of anybody that's over $100,000, basically prorated, essentially. And then also federal employment taxes are not included. Again, the employer share is not included, so the employer share of FICA, Medicare taxes is not included in that, so you can't include payroll taxes. And the employee share is also not included because it's already in the gross wages, essentially. So think of it, employees' gross wages can't take employer payroll taxes. Compensation of an employee who has a principal place of residence outside the United States, they're out, can't use them. And then if you have qualified sick leave or family leave wages for which a credit was allowed under the Families First Coronavirus Response Act, since you got the credit, they don't want you to double dip there. So what's the maximum loan amount? Maximum loan amount for most employers, lesser of $10 million, that's the max, or the sum of 2 times the average total monthly payroll costs incurred during the 1-year period before the loan date or the calendar year 2019. Probably 90% of the people use the calendar year 2019. So they took their payroll cost and convert to a monthly amount, multiplied by 2.5. So it's really 2.5 times your average monthly payroll cost is what you get the loan for. And then if you have an EIDL loan outstanding, you can use that and throw it in there and refinance it, other than the $10,000 advance. If you're a seasonal employer, essentially, basically you could take the same thing, limit it to $10 million, but you basically get to use different periods. So it's 2.5 times the average monthly payroll for the period February 15th, 2019, or you can use March 1st of 2019 through June 30th of 2019. They also modified that with the guidance and allow you to use, because seasonal means different for different seasonal employers. So you can also use a consecutive 12-week period between May 1st of 2019 or September 15th, 2019. So really you can use any one of those 3 periods, essentially, for a seasonal employer. Lots of flexibility there. And again, you can add the appropriate portion of the EIDL loan. If it's a new employer, what do? Well, basically you can, again, limit it to $10 million, but you weren't in business in that stub period, okay, or you weren't in business from February of 2019 to June 30th of 2019. So you can use basically the average monthly payroll cost 2.5 times from January 1st, 2020 through February 29th, 2020. So if you're a new employer. So lots of options there. So it's really basically the base that you utilize depending upon whether you're a normal employer, a seasonal employer, or new employer. Self-employed employees and no employees, we try to figure out how do we do that with a self-employed person that basically earns income off their Schedule C, and they may take the money out of the business, they may not. Well, he did simplify that with the guidance. So if you have no employees, you simply go to your Schedule C, which is your proprietorship form on your individual tax return, and look at your net profit, line 31, it's your net profit. And if you didn't file a 2019 return yet, you just fill it out and compute the value. which is kind of a scary proposition because if you don't do your own tax return and you did it and your account wasn't involved, it'd be interesting to see what that Schedule C looked like. But in any event, that's what you're supposed to do. If the amount's over 100 grand, you reduce it to 100 grand. If it's 0 or less, means you have a loss, you're not eligible for the loan. This is if you have no employees. In step 2, so you take that amount just like the other calculation, you compute your monthly net profits, you divide by 12 essentially, then you multiply it by 2.5 times, same calculation as the other calculations, and then you add your EIDL loan if it qualifies. So again, no employees are really taking your net income. You're considered one employee with your net income from your self-employment income. So that applies to a Schedule C, and also if you're in the farming business, a Schedule F would also apply, essentially. Unfortunately, if you're in the rental business, you're a landlord, it doesn't apply because you're not considered, those loans are not eligible for, landlords are not eligible for SBA loans under the other SBA guidelines, and they didn't modify that. So anybody that has passive rental income, technically you're not allowed. And I know many landlords did apply and got the loans. Remains to be seen what happens with those loans. Now, if you're a real estate developer and it's self-employment income, it would qualify. So as long as it's self-employment income, farming, other self-employment income, it would qualify. So what if you do have employees? You do the same thing. You take your Schedule C, line 31, to compute your net income, essentially, limit it to $100,000. If you had a loss, you don't get it for you. But then you also take the gross wages of your employees. So the same calculation as with other employers. You basically take your gross wages for all your employees, and you get those mainly off the 941s. And basically you subtract out any compensation to pay to those that are making more than 100 grand, and anybody that's working outside or lives outside the United States. So the same rules apply. So if you do have employees, you're doing the same calculation, your net Schedule C, plus you're taking the gross wages of your employees. And then you get to take the employer health insurance contributions and retirement contributions of state, local income taxes. So it's pretty much the same calculation. You calculate the average monthly amount. So you divide by 12 and multiply by 2.5 and add the EIDL loan if it applies, essentially. So the only difference with the self-employed is you're really using your 2019 Schedule C net income as a proxy for your wages, basically, for you. It's the self-employed. Everything else is pretty much the same as the other calculation. Okay, so the loan forgiveness amount. So now we got our loan. Now how do we get it forgiven? Well, basically, you're able to eligible forgiveness on a covered loan in an amount equal to the sum of the following costs incurred and payments made during the 8-week or 24-week period. So it was an 8-week period. The new law, the Flexibility Act, modified it to a 24-week period, and you'll see you'll have the choice if you've already got your loan. If you're getting your loan now or after June 5th, you have to use the 24-week period. So basically, you can pay these costs now over a 24-week period. And it can't end after December 31st, 2020, which in most cases it won't. It should end after that. So it's payroll costs, which will define interest payments on a debt instrument. Basically, that's a mortgage on real or personal property, and that was incurred before February 15, 2020. So again, it could be mortgage on your rental, a building, it could be a mortgage or a secured loan on a vehicle. Those things would qualify. Rent payments under a lease agreement dated before February 15, 2020. So you can't get a new lease agreement after February 15th to apply that. It's got to be in place already. So we're recommending that you should have written related party lease agreements that are in place, hopefully, to support that. Utility payments related to the distribution of electricity, gas, water, transportation, telephone, or internet access. A lot of people are saying, what does that mean? What is included? And they want to include everything under the sun. Well, with this 24-week period, it's not going to be as important, but pretty much it includes a lot of things. It basically includes, internet access. So if you're reimbursing employees for internet access or cell phone use, those should all qualify because telephone and internet access qualifies essentially. Also, in one of the SBA guidance items, I think it was the April 14th one, the interim final rule, they also allowed to be included in utilities, gas for your vehicles. So gas on your vehicles. Now this was under the self-employment provisions, but it should apply for other businesses as well. So we feel it includes gas on vehicles also. Does it include garbage? There's really not, a lot of people are including it, but I'm not sure that's utility right now. It's not specific to that. So if you do include garbage, the SBA or the lenders might look at that and throw it out and say this is garbage and not include it. So again, so most things are pretty straightforward in utility payments, but it's really whatever cost you incur if you use a utility broker, those costs you qualify as well, because that's what you're paying to get your utility services. Tipped workers, basically the tips will qualify. Okay, so the covered period now is 24 weeks or 8 weeks. So it begins on the date that the lender makes the first disbursement of the loan. That's when it begins. So the day you get the loan, that's when it begins. And if you received your loan prior to June 5th, 2020, you can either use the 8-week period or the new 24-week period. If you received your loan June 5th or later, you will have the 24-week period, basically. Also, there's an alternative covered payroll period, essentially. People got concerned, what if I got my loan, I was right in the middle of a payroll? You can actually start with, once you get the loan, you can start with the next payroll date, essentially. On that. So it begins with the first day, the first pay period following the loan disbursement date, if you want to choose the alternative payroll period, just so that you could have even payroll periods during the 8-week period or 24-week period. So basically the payroll cost, it's paid or incurred during the 8-week period, 56 days, or the 24-week period, which is 168 days, essentially. And again, that's on the date the disbursement occurs, basically. What does that mean? Payroll costs are considered paid on the date the paychecks are distributed, or the borrower originates the ACH credit transaction. Payroll costs are incurred during the borrower's last pay period, basically, of the covered period or alternative covered period, are eligible for forgiveness if paid on or before the next payroll date. So you actually can make payroll costs after the covered period if it's the last payroll, essentially. What they want you to do is make sure you get all your 8 weeks in, and if it's bi-weekly, be four pay periods. So they want to make sure you can get all those in. And payroll costs are generally incurred on the day the employee's pay is earned. If you're paying employees that aren't working, it's their normal time that they would work, essentially. Okay, so again, here's just a quick example. We're using an 8-week period that begins on June 1st, ends on July 26th. And it starts, the first payroll cycle starts on in the covered period is June 7th. So the borrower may elect the alternative payroll covered period for payroll cost purposes that starts on June 7th and ends 55 days later, August 1st. So essentially, basically those costs during the covered period are eligible. So if they're incurred during that period, as long as they're paid before the first regular payroll date occurring after August 1st, essentially they qualify. So again, you can just shift your pay periods. In this case, it started June 7th, and your covered period ends on July 26th, but you can still use that payroll that's paid on August 1st, essentially. Not a real big deal if you follow through on it. Our wages, how about bonuses and payments to furloughed employees and hazard pay? Do they qualify? Common question, can I pay my employee a bonus or raise? In many cases, we had to do that. To get them back to work, you had to pay them more because why? They're making more on unemployment. So if somebody made $800 a week, the state unemployment gave them roughly 50%. So they gave you $400, then you got a $600 stipend from the federal government. So you're making $1,000. Why go back to work for your $800 of pay? So sometimes employers had to pay more to get them back, and those do qualify. So the bonuses, hazard pay, those will qualify. Again, you're still limited to the $100,000. So when you look at the $100,000, essentially on a prorated basis, if you're paying bonuses for those individuals, those amounts, those bonuses wouldn't qualify because you're over the $100,000 threshold. So normally for the 8-week period, the $100,000 prorated works out to be $15,000. So therefore, if somebody works, you pay them more than $15,385 during that covered period, which includes bonuses and everything else, you're capped at the $15,385. It's questionable whether those that are over the $100,000, if you use the 24-week period, does that mean you can use a prorated salary for the 24-week period, which would be around $46,000? We think so, but still that's yet to be determined. It still may be capped for those 100-grand employees at $15,000. But in any event, bonuses, hazard pay, additional compensation does qualify unless you've got the 100-grand limitation. what are our caps? Here's the caps on basically owner employees and self-employed individuals. Again, essentially, if you're using the 8-week period, their cap is $15,385. You can't pay them more than $850 seconds of the 2019 compensation. And this is unique. You don't have to look at 2020. So even though you're in the covered period, in the loan forgiveness period in 2020, you still go back to 2019 and use 850 seconds of that 2019 compensation, or limit it to $15,385. So it's already been determined what your forgiveness is for a self-employed individual, which means if the applications, the corrected applications are out, you could apply for forgiveness now if you're going to use the 8-week period. But possibly it may include 2450 seconds of the 2019 compensation, which is $46,154 limit, essentially. And we think that's what it should be under the law, that since they gave you 24 weeks, that should be expanded to $46,154 as a limit. But you're going back, what's unique, going back to 2019. You don't have to worry about 2020 for self-employed individuals. Owner employees are capped basically on their 2019 cash compensation and employee retirement, the health benefits. So that's Schedule C filers, as I just mentioned, capped at the profit, their 2019 profit calculation. So again, 850 seconds or $15,385. And same thing with general partners. Then you get that information off the K1s. Now what's interesting is there's no additional forgiveness is provided for retirement or health insurance contributions for self-employed individuals, including Schedule C filers and general partners, as such expenses are out of their self-employment income. So this is a little bit of a problem. When the FAQs came out, I think it was one of the FAQs, FAQ 7 from the SBA, one of the questions asked was, hey, if we limit the $100,000 compensation, is that just cash compensation or do we include all the benefits as well? And they clearly said it's just the cash compensation. You get the $100,000 plus you get your health insurance and retirement benefits. Great. Well, now they got this, comes out and it says no forgiveness for your retirement or health insurance. Now, if you're a C corporation owner employee, you would get that because those are reported in the body of your return in your net income. They're reported someplace else. But because a self-employed individual or a Schedule C individual or a partner, essentially, their health insurance and their retirement benefits are reported on the first 2 pages of your 1040. They're not reported in the Schedule C. And it clearly says you have to use your employee amounts that are reported on Schedule C, essentially. So there's a little disconnect there that pretty much right now under the guidance, retirement benefits and health insurance benefits for owner employees or self-employed individuals and Schedule C filers and general partners, you're not going to get it. So thank God for the 24-week period, because I don't think you're going to need it now. But you don't get it right now. How about non-payroll costs, paid or incurred, essentially? So this is interesting. Big question that you usually ask. Can I prepay all my rent for the rest of the year, and as long as I pay in the covered period? Well, what the law says, it really says paid or incurred. So it's kind of like, what does that mean? Paid means paid during the covered period, the 8 weeks or 24 weeks. Incurred means incurred during the covered period, and paid on or before the next regular billing date, even if that billing date is after the covered period. So if you have an expense that you incurred during the covered period and you paid it on or before the next regular billing date, then it's covered, essentially. So let's take an example. A borrower's got a covered period that begins on July 1st and ends on July 26th. Essentially, the borrower pays its May and June electricity bill during the covered period and pays its July electricity bill on August 10th, which is the next regular billing date, essentially. It's after the covered period, but it's the next regular billing date. You're going to get the forgiveness on the May and June electricity bills because they were paid during the covered period. In addition, the borrower is also going to get forgiveness on the portion of its July bill through July 26th. So even though you pay on August 10th, beyond the covered period, since it's incurred, the part that was incurred through July 26th, that part counts, essentially. So what it appears is that you really can't get prepayments. If you haven't incurred it during the covered period and haven't paid it on the next billing cycle, you aren't going to get it. Which means, in this particular case, if you were paying August rent, since it hasn't been incurred, it's incurred August 1st, let's say, in this particular case, and your period ended, covered period ended July 26th, you're not going to get that prepayment for the August rent, essentially. So you can't prepay the next 6 months rent. Now, you could be creative and say, what does incurred mean? Once I sign the lease agreement, isn't it really incurred? I'm obligated for the next 10 years. That's being creative. I don't think it'll apply. And again, with the 24-week period, I don't think that's going to be a big issue. Self-employed, again, same thing with self-employed. Your payroll costs include salaries, wages up to the $100,000 and limited to the $15,385 during the 8-week period. And hopefully, the 24-week periods, it's limited to $46,154. Okay, you get to use the covered benefits for employees. So health insurance, retirement for your employees, no question if you're self-employed, but not owners, as I just mentioned. And what the amounts eligible for self-employed, same stuff. Your owner compensation replacement, remember you go back to 2019 and take 850 seconds or 2450 seconds if that comes in of your 2019 profit, so forth. And you got the same benefits for non-payroll costs, payment of interest, rent, utility, same thing. So now we got certain reductions. So when you do this, I'm going to show you a couple examples that basically once you go through this calculation and you get through your 8-week or 24-week period, now you also you might have to reduce that loan forgiveness if you have a reduction in your FTEs or you reduce the employee's salary. These get a little bit complicated, but I'll try and simplify it as much as I can. Okay. So what happens is the amount of your loan forgiveness shall be reduced by this certain calculation. You're really taking basically the average number of your FTEs during the 8-week or 24-week period and dividing it by the average FTEs during the base period. And I've listed the base periods there. Seasonal employers got basically additional base periods. The example is going to be a little more clear, so I won't spend a lot of time on this slide. And no more than 40%, used to be 25%, of the loan forgiveness can be attributable to non-payroll costs. The loan forgiveness cannot exceed the principal of the loan, so you can't get more forgiveness than what loan you got, including the accrued interest on the loan. Okay, so an example of this, if you look at the bottom of this slide here, the example, let's say a borrower had 10 FTEs during the reference period, the base period, okay, that we talked about, and it declined to eight full-time employees during the covered period, that 8-week covered period in 2020. So the percentage of employees declined by 20%, so thus only 80% of the otherwise eligible expenses are eligible for forgiveness. And you're going to see where this works out to be a double dip when I get to the example there. Also, you also have to reduce it by for employees that make less than $100,000 a year. If you drop their pay by more than 75% or more than 25%, to the extent you dropped it by more than 25%, that has to come off the loan forgiveness, and that's on a per employee basis. So this sounds complicated if you read it, but you're basically saying, look, if I paid somebody $1,500 a week before, now I'm paying $1,000 a week, I've got a big drop basically, right? I've got a $500 drop. Well, 25% of that $1,500 is what, $325. Yeah, $375. So really, the excess drop is like $125 a week, and that's the piece that $125 a week times 8 or 24. That's kind of the piece that would come off the loan forgiveness. So if you've got more than a 25% drop with employees, essentially, that has to come off the forgiveness. However, if you're being penalized if you drop that employee down, and let's say they're working less hours, the FTE calculation would go down, and therefore you don't want to be double penalized. So they said, you don't have to count them both. Now, what's nice about it is if you do have that drop, if you restore those reductions, so if you restore those wages back to the norm or restore the FTEs back to the norm, to what basically the norm is the February 15th FTEs. So you look at your February 15, 2020 and say, what were my FTEs at that point in time? What were the wages I was paying each of my employees at that point in time? And even though I cut them down during this covered period, if I restore that by not later than December 31st, 2020, I don't have to go through that crazy calculation, and I get full restoration of that reduction on my forgiveness. And you'll see that in the calculations, essentially. So the one question is, if I do it, what happens if I do it before December 31st, right? And then I reduce, and then December 31st, I knock it down again, and we have a new wave. We need some more guidance there, but it does say if you restore these wages and these FTEs before that date, not later than, technically the forgiveness is not reduced. So that might be a situation where you might want to get in your application right around that time. What if an employee declines? So what if you basically say, hey, I'm trying to get the employee back to work, but he didn't want to work. They're making more on unemployment. And so you don't have to consider those employees. That's not a considered reduction in your FTEs because they declined the offer, essentially. So that works. However, if they do decline, you have to have a good faith written offer to bring your employee back, the same salary or wages, same number of hours. And if the offer was rejected, you have to maintain records and technically you have to inform the unemployment insurance office that the employee declined the offer. But again, if they do decline, you wouldn't have to include those employees if you meet these requirements. What if the employee terminates? Employee's fired for cause, voluntarily resigns, or requests a schedule reduction. If the employee does that, says, I want, they're fired, they quit, or wants to reduce their schedule, again, you don't have to count those employees either in this reduction amount. So you got a lot of leeway here. Okay, so how do we calculate this thing? Let's go through a couple of examples. Payroll costs during 2019, $1.2 million. Average monthly cost, $1.2 million divided by 12 is $100,000 a month. So you take that and you get 2.5 months worth, 100,000 times 2.5 equals $250,000. Loan forgiveness calculation. So here we got a salary reduction. So now I took the payroll cost during, in my case, I'm using the 8-week period for this example, but it could be the 24-week period, $130,000, okay, essentially. And I simply took that and said, okay, it's going to be roughly based upon my payroll cost, my average payroll cost, it would work out to be about $130,000. And you'll see in a minute. My non-payroll cost, it's rent, utilities, mortgage interest, all that, is $100,000. It's limited to 40% of the loan, which the loan was $250,000, it's limited to $100,000. So my total cost incurred during the 8-week period is $230,000. Let's assume I have a salary wage reduction for a few of my employees, where I didn't pay them, I paid them less than 75% of what they were making before. That additional amount has to come off, so let's assume it's $10,000. So the total costs I incurred, $130,000 for payroll costs, minus $100,000 or plus $100,000 for non-payroll costs is $230,000. I subtract out my salary wage reduction, and my subtotal is $220,000. Now I look at my FTE reduction. Let's say the FTEs that I have during my 8-week period are 15, so I count them up, they're 15. My base period, which I can use either 2/15/19 to 6/30/19, or I can use 1/1/20 to 2/29/20, or consecutive 12-week period between 5/1/19 or 9/15/19 if you're a seasonal employer. So the seasonal employer has the option of 3 of those methods. The normal employer has the other 2 methods available. So whatever's the lower, you use in the denominator. So let's say during those base periods it was 20. So basically saying when you're back at full force, using one of those periods, you were at 20 FTEs. Well, on the covered period, you have 15 FTEs. So 15 divided by 20, you're at 75% of full force, essentially. So now you take the loan forgiveness amount above of 220, multiply it by 75% equals 165,000. Now here's where there's a little bit of double dipping. I don't like this FTE reduction because what's really happening? In the $130,000 above, you're already taking the loss. Since you don't have as many employees back, that payroll cost number is already being reduced by 25% because you got 25% less employees. So now this is kind of a double dipping where they're hitting you again. So I really don't like this reduction. So I like the safe harbors to restore it, but that's what the law says. So right now you've got a loan forgiveness amount of $220,000 times 75% or $165,000. You also got a payroll cost limit. And the way that's calculated is you take your payroll cost, which is $130,000 above, divide it by 60%, because that's the max, that's the amount you should use, and it comes out to $216,000. So you got that limit. And then you got your PP loan amount limit, $250,000. So your forgiveness is the lower of those 3 items. The loan forgiveness amount, which is $165,000, the payroll cost limit can't go beyond that, $216,000, or the loan amount, $250,000. And lo and behold, you've got $165,000. In addition, the SBA is going to, if they gave you the $10,000 IO loan or $10,000 or less, whatever they gave you, that's a grant, they're going to knock that off. They're going to automatically do that. You don't even have to have it on the calculation. But you end up with $165,000 because you didn't bring everybody back. So if a $250,000 loan, you're getting $165,000. Not the best, but you'll see it gets a lot better with the 24 weeks. So let's say we do have a payroll cost limit. Let's say that we fully restore. So I've got, same example, $130,000 of payroll costs, non-payroll costs, 100 grand. And so I bring it's 230,000. Since they brought everybody back at full wages by December 31st or June 30th, whatever you did, essentially, I don't have a salary wage reduction. Even though I may have that cost, I didn't have that cost in the covered period, I met the safe harbor. So I brought the people back at least by June 30th or under the new law, December 31st, 2020. So my total costs are $220,000. My FTEs are 15 during the covered period, essentially, and 20 during the base period. Same calculations before. However, I'm using a quotient now of 20 divided by 20 or 100% because I brought back my employees by December 31st. I brought back my employees to 20 employees. So therefore, I don't have to use the 15 during the covered period because I did ultimately bring them back before December 31st, 2020. So I get a full restoration. I don't have to use this crazy quotient anymore. So now I take my total cost of $230, multiplied by 100%, I get $230,000. However, I got my payroll cost limit, which is 130 grand divided by 60% or 216, because I got too much of non-payroll costs up there, essentially. Even though I didn't spend more than 40% alone in non-payroll costs, the forgiveness piece I did, so my limit is $216,000. My PPP loan is another limit, $250, so it's a lower of the three of those, so you can only forgive $216,000, essentially. But you can see, you went from $165,000 of forgiveness to almost full forgiveness, $216,000, just by bringing back those employees at some point in time or restoring their wages. So that's how powerful this safe harbor FTE reduction and salary reduction is if you do bring it back eventually, which I think we're all going to bring it back, at least by December 31st, hopefully. And if you don't bring it back by December 31st, you might have a tough road for other reasons. You might not even be in business. Hopefully that's not the case. Now let's look at the 24-week period. So now if my payroll cost during the 8-week period is $390,000, so I basically tripled it. I said, 8 weeks it's $130, 24 weeks it's $390. My non-payroll costs are still limited to 40% alone, 100 grand. Total cost $490. Assuming I kept those employees' wages down during the covered period, so I multiplied the 10 by 3. I figured I'm with a $30,000 wage reduction calculation. My subtotal is $460. Okay, so now let's assume I don't do any restoration here. Okay, so this is the 24 weeks. So I had 15 during the whole 24-week period. Didn't bring everybody back. I was at 75% of full force, 15 divided by 20. 460,000 times 75% is 345, essentially. So 345, basically, that's the limit. I take my payroll cost limit, 390,000 divided by 0.6. It's $650,000, huge limit. PPP loan amount is $250,000. So what's my limit? Now I'm limited to loan amount. I spent a whole lot more than my loan because I had 24 weeks, essentially, when I really had 10 weeks of money that I borrowed off of. 2.5 months is roughly 10 weeks. So I spent a lot more money, well beyond my loan amount, so I limit my forgiveness to my full loan amount, and that's all we were looking for, is to get this whole thing forgiven. So in most cases, probably 90% of employers are probably going to use a 24-week. Even though you could use the 8 weeks, you're probably going to go with this 24-week period, essentially. Application documentation requirements, there's a bunch of things running short of time here that you have to submit, but it's a normal documentation, payroll records, that sort of stuff. If you don't provide the documentation, you won't get your loan. Once you apply for your application, your forgiveness, the lender's got to make a decision within 60 days, so that's a good thing. Loan forgiveness tax issues, big problem here. As you might remember, the CARES Act said the PPP loan forgiveness amount is excluded from gross income. And then the IRS came out with Notice 2020-32 saying, yeah, even though it's forgiven under Section 265, any expenses applicable to that loan are not deductible. So what they gave you, they just took you away, took it away from you. And that's a problem. If you've read articles on this, you think it's appropriate, I do not. There's no question Section 265 is around. It says you can't take expenses, deductible expenses, attributable to tax-free income. Now, if you look at like tax-free interest, your expenses related to that might be broker's fees, very small, but most of that forgiveness or tax-free interest you're getting forgiven or not taxed. In this stage is dollar for dollar because you get this grant, so to speak, which is forgiven, and you have to use it for these payroll costs. And it doesn't make sense that you would say in the law, we're going to make this tax-free and then not have the expenses deductible, because they might as well have left it alone. They might as well just said, let's make it taxable and you get the deduction for your expenses. You end up in the exact same position. And a lot of articles out there saying, hey, this is right because we're double dipping. You are not double dipping. You got the benefit for the expenses anyway. You were given an additional benefit for forgiveness and they took it away. And the best analogy, since it's called double dipping that I can think of, let's say you go to an ice cream parlor and you get an ice cream cone with 1 scoop of ice cream. And the owner, Joe, says, you know what, because it's COVID-19, I'm going to give you an extra scoop. And you go, really? I didn't expect that. That's really nice of you. And then his employee, Iris, sounds like the IRS, Iris comes along and says, you know, you got the extra scoop. We're going to take away the bottom scoop. So you end up back with 1 scoop of ice cream. And you go to Iris, goes, wait a minute, but Joe, the owner, says I could have it. And Iris says, no, you don't get that because that's our rule. And so you go to Joe and complain, and Joe goes, well, what can I do? Iris took it away. But Joe, you're the employer. You control Iris, who's your employee. You should have some say in this. So this is what you should do with your congressman. You should go to your congressman and say, look, you gave us this forgiveness piece, and now the IRS took it away. Go back and amend the law and allow the expenses to be deductible. You really should push and fight this. We're pushing it on the CPA level. We just don't think it's appropriate. It's pretty clear under the CARES Act it was meant to be forgiven. Another way to argue this as well, we're talking about COVID-4 or maybe more relief. This would be a nice way to say, rather than provide more money or a lot more money, why not just allow the forgiveness to continue, allow the deductibility expenses so that employers can use those funds to continue their operations rather than go out and get more money. So there's a couple ways to argue this. You should fight it. If you get the employee retention tax credit, it's not available. If the PPP loan is received, that's not available. Essentially, we'll talk about that in a minute. And then the employment tax deferral, essentially, that's not originally available if the PPP loan was forgiven. That's where you can defer your employment taxes, basically to 2021 and 2020, 50% to 2021, and another 50% to 2022, essentially. If your loan was forgiven, essentially, you couldn't get that. You couldn't get that deferral. Now the Flexibility Act does allow for that deferral. So the employee retention credit you still don't get if you get the PPP loan, but the other one that was the deferral originally said if the loan is forgiven, you can't do the deferral, but now you can. So that's changed if you want to defer your payroll taxes, but you do have to pay them eventually. So the terms of the unforgiven portion of the loan, what are the terms? The interest rate's going to be 1%, stayed the same. Maturity loan is 2 years for loans prior to June 5th, but you can work with your lender to extend that, essentially. And it's 5 years for loans made after June 5th, so for the unforgiven piece. The payments are deferred until the SBA decides the forgiveness amount, but you got to be careful. You got to make sure you apply for forgiveness within 10 months. If it's after 10 months, then they're going to start making you pay the unforgiven piece back right after that. Interest will accrue on the loan beginning with the disbursement, but remember that gets forgiven. That portion of the interest will be forgiven to the extent the loan is forgiven. So just quickly, the PPP Protection Act, what it did allows you now to extend your 8-week covered period to 24 weeks, essentially. So if you already got the loan, you can pick either one, essentially. If you didn't get the loan yet, you're stuck with the 24 weeks, which is not being stuck because that's probably what you should be doing, essentially. So it's 24 weeks up to December 31st, essentially. The deadline for loan applications still continues to be June 30th. The 75% payroll expenditure, it's been reduced to 60%, which is great. We have more room for non-payroll expenses, even though that won't be that big of a deal with a 24-week period, essentially. There was a concern that if you spent more than 40% or less than 60% on the payroll costs, that you might not get any loan forgiven. And that's the way the act was drafted, but they clarified that in the most recent interim final rule, which was issued on June 11th, 2020, saying no, it's prorated. So if in fact you did spend more than 40% on non-payroll costs, that's the problem. It will affect your forgiveness, but it won't eliminate it. Again, because the loan amount's based on 2.5 months of payroll, you're going to have a great chance of getting all of it forgiven with the 24 weeks because you got 24 weeks now instead of, say, on monies that were basically 10 weeks. The safe harbor extended. Before it said you had to bring back all those employees for the FTE and the salary reduction by June 30th. Now it's December 31st, essentially, on that. Also, there's a lot of new exceptions too. That if you rehire employees who are employees that basically you hire them, the new exceptions for the FTE reduction basically is available if you document your inability to rehire employees or hire similarly qualified employees or return to the same level of business. So again, there's a number of ways to get back to your FTE requirements so you don't have that double penalty we talked about. If you can't get your employees back, essentially, or they don't want to come back, they're not going to affect that quotient reduction we talked about. Repayments extended to 5 years, we talked about that. We talked about the deferral on that. So questions, where additional guidance is still needed, can a borrower use June 30th FTE reduction safe harbor instead of December 31st? We don't really know. So what it says, if you bring back your FTEs before December 31st, 2020, what happens again if you bring it back and then you cut your employees again? What happens after that? Or do we have to use December 31st, 2020? Do we have to maintain that level of employment through the end of the year? We don't have a good answer on that. Same thing with the salary and hourly wage reduction. How has that changed? Same thing. Do we have to bring them back up or bring the salary back by December 31st, or we can do it before? Now, what happens if you restore your FTEs and salaries using the safe harbors before December 31st, but don't maintain that safe harbor? That's what I was trying to get to. Do you lose a restoration benefit? And possibly if you bring them back in September, and you're beyond your 24 weeks, and you file your application, and you get your application approved, nobody really cares what happens as December 31st if we have a second wave. I think if we have a second wave, we'll see another modification in this law anyway. Does a limit on cash compensation change to $100,000 times 24.50 seconds, essentially, from $100,000 to $852? So $15,385. I think it should. And now that you're getting 24 weeks, you should expand that, so the limit should be $46,154 versus $15,000. And now this is a critical one that a lot aren't thinking about. I am. With a 24-week covered period, borrowers will spend well beyond their PPP loan amount. How do borrowers document what costs were paid from PPP loan funds or other funds? This could be a problem for borrowers that spent most of their PPP loan funds already, where more than 40% of which were for non-payroll costs. Can you now go back and say, wait a minute, I'm over the 40%, which infects my forgiveness. Can I go back and reallocate and say these non-payroll costs came from other funds and the PPP loan funds that were restored will be used for future payroll costs? So if you're using a separate bank account like we recommended, do you go back and say, now that I got 24 weeks, I might want to reimburse that loan account, essentially, that bank account, for those non-payroll costs, because I don't want to get anywhere near that 40%. And then I start using those funds for future payroll costs. So we don't know how the bank or the SBA is going to look at that, but because the rules have changed in the fourth quarter, I think they're going to be pretty flexible. That's why they call this a Flexibility Act. And we're probably going to say, look, as long as you got the payroll records for that 24 weeks that get you to where you need to be, we're going to allow those. They're probably not going to look at the separate bank account so much and so forth. We recommended the separate bank account so we can have a better tracking and a separate spreadsheet, but I think that might be a little bit out the window now. I think you can modify that a little bit with this 24-week period, essentially. Because we're pretty much at the end, the payroll tax provisions is really, you have a deferral of payroll taxes. If you basically, you're down in business, essentially, you can defer your payroll taxes to 50% next year, 50% a year later on. So it's just a deferral. If you have, since we're talking about PPP, if you got there's a reduction credit where you can take 50% of qualified wages under certain conditions up to $10,000. So it's like a $5,000 credit. So if you do have brought back employees back and you have less business and so forth, you can get a retention credit of $5,000 per employee. You can't get it if you get the PPP loan, but you can get it if you don't get the PPP loan. So with that, I think I'd just like to leave it open for questions. I know we're right at the hour. I expect to get done sooner than that, but I'm willing to stay on as long as you want to answer questions because I know they're important to you. So Brian, if you want to hit me with some of the questions, I can do that.
Yeah, absolutely, Mike. And thank you for the content and, really going through your presentation. You've answered a lot of the questions that have came through the chat here. So really, really great content. So our first question comes around determining FTE, so the full-time equivalent. So there appears to have been changes to that definition from the SBA. So 30-hour FTEs are now considered part-time, where the IRS considers FTE at 30 hours or more. So
Right.
are there any ways that we should calculate it, or do we just go by the SBA rules?
SBA, because the IRS calculation, that was under the Affordable Care Act when you calculate full-time equivalent, so it was under that particular provision. So many thought you should use 30 hours, but it's clear with the guidance that you can use the 40 hours. And many people were saying the normal full-time equivalent is 40 hours. So it's clear 40 hours or more, you're 1 FTE. Less than 40 hours, let's say it's 30 hours, you divide that by 40, it's 75% FTE. Or if they're less than 40 hours, alternatively, you can just count them as a half a FTE. So as long as you use them for each calculation, when you looked at my quotient, you got to use the same calculation, the numerator and the denominator, the same methodology, you're fine. So many will probably use, over 40 hours is a 1, under 40 hours, maybe a half of employee or FTE.
Great, excellent. Mike, this question comes around profit sharing contribution considered under the retirement obligations.
Yeah.
So if you planned on getting back to full employment for June 30th and apply for forgiveness, then realize that you would have been better off using December 31st period for the forgiveness, are you able to amend the forgiveness application, or are you locked into the June 30th number?
Okay, well, June, you're talking about the 8-week period or the 24-week period is what we're talking about, basically, right? So basically, you have leeway here. First of all, the application that came out is going to be modified, so you can't even apply for forgiveness. But you don't have to jump. We're recommending you wait, because there's going to be more guidance coming out. But even with the guidance that we have, you still want to look at it and say, let's calculate our forgiveness if we use the 8 weeks, and let's calculate our projected forgiveness if we use the 24 weeks. Essentially, and then you can make a decision. So once you apply, if you apply and use the 8 weeks, I don't think you're going to be, right now, there's no guidance out there that says you can go back and amend, essentially. Now, the thing that you're dealt with is say, wait a minute, what if I don't restore all my employees, now I got this full-time equivalent calculation where they're down. If they're down for 24 weeks, that could have a greater impact on my forgiveness calculation. But remember, you're going to have a lot more payroll costs being expended. I'm finding in most cases, you're going to want to go with the 24 weeks. And you can pretty easily project that. But once you apply for the 8-week forgiveness calculation, you might not be able to go back and amend. But further guidance will let us know if we can do that.
Yeah, and Mike, that goes to the next question. So why would a company use an 8-week period when they would be able to use the 24-week period?
Because if they already calculated and they said they brought back their employees and they already know they got 100% forgiveness, why not get it in, beat the rush, and get it forgiven and get beyond it, basically. It might minimize audit requirements, all that sort of thing. They've already got their money, and they're assured that it's going to be forgiven. So if you already know the answer, so if you spent most of your money on payroll costs, which is a sure bet, it's a non-payroll cost that, what qualifies, what doesn't, and you spend it all and you got 100% forgiveness under your calculation, why not file and get it under the 8 weeks?
Mm-hmm. Mike, under the utility payments, so are cellular services included as telephone?
We think so. I think so. Yeah. Based upon the guidance that I've read, yes, it's telephone. Everybody's telephone's a cell phone now anyway. Even reimbursements to employees should qualify. So I think the answer to that is yes.
Great. This is in regards to the alternative covered payroll. So we received the disbursement on payday. Will this be the date of disbursement, or will I be able to use an alternative covered payroll?
That you use the date of disbursements the first day, so that pay period would count under the normal rules because it's paid right on that date. But you can use the alternative basically, so the week after that pay date. So you could use the next payroll period, but I'm not sure why you wouldn't want to use that first pay date anyway. Mm-hmm, mm-hmm.
This question is regard to rent. So what if you paid rent due the month prior to receiving the PPP funds? Would that be would I be able to include that in the expenses?
I think so. With that one, in the example with utilities, that example I had there, they actually allow the payment of the May utilities was paid during the covered period. But clearly those utilities were incurred before the covered period, and they allowed that in the example. So I think past rent you probably could pay. If you didn't pay your past rent because it was incurred, and you did pay it during the covered period, so it's already been incurred and you paid it during the covered period, the previous month's rent would qualify. I think future month's rent is where you got the problem. And it's based upon that one example that I had on my earlier slides.
This next question is regards to the $100,000 annualized limit. I know you talked a lot about that with the 8 weeks and the 24 weeks, but are commission payments limited to the $100,000 annualized amount?
Yeah, what you're going to look at your total wages, whether you're going to look at your base pay plus commissions and look at that total amount and come up with an average per week generally, and that's how you're going to do the calculation. So commissions are going to be included in that compensation amount. So if you're making, let's say, a $30,000 annual base salary, but you get a $100,000 commission, it's like $130,000 salary, and then you prorate it out basically.
Mike, is there so let's say that during the time period, and we expended to 24 months. So in essence, can you stop after any time in between the 8 to 24 week period once you know you've used the funds and you have your FTE restored to receive 100% forgiveness? Or would I have to wait until 24 weeks out to apply for that forgiveness?
I think you're going to be able to do it. We're waiting for more guidance on that. That was one of my questions there. But I think you're going to be able to do it because the law says if you restore it on or before December 31st. So if you've already restored it, I think if you're done, you could apply for that forgiveness and get it forgiven and not have to worry about December 31st. And that's probably the approach that I would take, because in any event, if you went down, all they can do is lower it. If you got your forgiveness done, you're pretty much done. But I think we're still going to be waiting for more guidance to see if that changes. But the law does say restore on or before December 31st, which gives you that window of opportunity to apply early.
Great. And, continuing along with forgiveness there, the forgiveness audit, will that be conducted by the lending bank or the SBA? The
audit will be done by the SBA. What the bank is required to do, think of it, the banks are technically held harmless here. They're going to do an overview. They're going to get your information. They're going to look, did I get all the documentation? They have to make sure they get all the documentation and make sure that it's reasonable. They don't have to audit everything. They've got enough information they can go off of. They don't have to go through a crazy audit and so forth. So they're held harmless. The SBA is the one, if they come in, they'll probably do a little bit more of an audit. My guess is with all these loans, 4.5 million loans out there, they're probably not going to do many audits. Essentially, and I think they're probably going to look at the documentation to see if the documentation is in order. We're going to see, were you an eligible employer or borrower? I think they're going to look at those things, essentially, like the 500 employee rule, that sort of thing. They're going to look, is the documentation look complete? That sort of stuff. So I think they're going to look at that, and they may look at, if you're bumping up at the 40% of non-payroll costs, they may look at that to see if you tried to include everything under the sun. That sort of thing. So I don't think the SBA will do a full audit. I would call it more of a review. Also, the SBA indicated, even though they can audit any loan, they indicated that if in fact they're going to look at every loan over $2 million, and they'll probably leave loans under $2 million alone. Doesn't mean that they will. They suspect something, they won't be a problem. Oh, just one other thing too, is they also said even though these are foilable or supposed to be, they're not going to release information of who got loans and who did not get loans at this point, which is a good thing.
Great, Mike. So this next question comes along as a self-employed individual. So I file as a sole proprietor. Being self-employed, I have no employees. Am I considered the employee?
Yes. Yeah, and when you do your FTEs, you're considered the employee for that purpose, yes. So whatever you made in 2019, basically, you take 8/52 seconds of that, limit it to $15,385, that's your amount.
Can PPP be 100% forgiven with payroll costs only?
Yep. Well, yes, but you also have to run through that full-time equivalent calculation, salary reduction calculation. So assuming that's not a problem, or you restored those, absolutely.
All right, great.
In fact, just to follow up on that, I would encourage anybody at this point right now, don't go crazy on prepaying rent and all that. I'd stop all that. If you're going to use a 24-week period, put it all toward payroll. So you're not even close to that 40% limitation. just put it toward your payroll. It's going to be a lot easier. Say, look, I met it with all just my payroll. Yeah, I did pay rent and all that, but I met it with my payroll. Say, just look at the payroll records alone. I'll give you the other stuff, but I made it on the payroll alone. It'd be a lot easier audit.
Great. So, Mike, I got the loan money in our account on June 1st.
Yep.
Would I use the 8-week calculation or 24-week calculation?
You can use June 1st, you can use either one because it was before
Sure.
June 5th.
All right. We have some repetitive questions here, so I'm just going through those. We received our PPP loan on April 20th and have been following the original rule for payroll versus other expenses. Can we extend other payroll expenses to 9 or 10 weeks or only extend our other expenses?
Well, basically, for the payroll, you can use the alternative payroll period, basically. So it's based upon the payroll costs or costs associated with that during the alternative period. So you could extend it and use the alternative period. So if the next pay date is like the following week, you could start with that period, and you could go beyond the covered period as long as you pay it within the next cycle, basically. So it's payroll and the payroll-related costs.
Brian, this is Ben. Why don't we do one more question, and then we'll wrap up.
Yeah, absolutely. So we've been approved for an EIDL as well as the PPP, which has been exhausted. Can you talk about any offsets between the two?
Yeah, basically with the EIDL, it's the $10,000 grant money that you got. So I don't know what the EIDL loan was in this case, but let's say it was 250 grand. And let's say the first 10,000 is really a grant. That 10,000 piece that you're going to get back that's forgivable or a grant, that has to come off your forgiveness piece, the 10,000. And the SBA is just going to take it off automatically. And the other piece just remains, it becomes a loan.
Okay, great. Well, Mike, thank you. And I'm going to pass it over to Ben there.
Hey, folks, I've been tasked with just closing us out. This is Ben. I'm Chief of Staff at Center State, if I don't know all your faces. I'd just like to thank our friends from Dannible McKee for I think, setting the record for total amount of slides in one of the webinars we've done on these Friday webinars. So appreciate Mike for taking the time to run through all this detail with us. This is also one of our most popular webinars, so we appreciate you all dialing in. There were a number of questions we didn't have the chance to get to. There was a lot of detail, situational specific questions. If you do have more questions or we didn't get to yours, please submit those at support@centerstateceo.com. We can potentially address them at Center State with our team, or we can certainly loop in our friends from Dannible with additional questions we aren't able to address ourselves. I did want to remind you all that we did record this session. It will be available online very soon today for you all to take a step through and review all of Mike's slides with a fine-tooth comb, because they're incredibly detailed. So we appreciate you all taking the time. To our friends at Dannible, thank you so much for joining us today, and everyone have a great weekend. Thanks, folks.
Thanks, everybody.